Hello everybody, this is AK. I'm back. So I thought there wouldn't be another video this week or this month, but never say never. I injured myself last night, and now I'm stuck at home. Yeah, too painful to walk. I kicked the corner of my sofa, and my baby toe is very swollen right now, very painful. Anyway, so I'm just stuck sitting on my sofa, elevating my foot, and decided to look at some stocks. And of course, I look at stocks which I'm interested in. And one of them is Alibaba. And, in a recent video, I say I bought more Alibaba shares at about 99 Hong Kong dollars per share. And just to make it clear, I actually bought the Singapore Depository Receipt, the SDR equivalent of Alibaba shares. So you take the Hong Kong share price, divide by 5 times 0.17, which is the exchange rate, you arrive at the SDR price that I paid, right? So I think it was $3.30 something cents, right? So anyway, that was the lowest price I paid in the recent market tailspin, right? Resulting from Donald Trump's crazy tariffs. Everyone's fearful. And on the 7th of April, there clearly was some capitulation, right? Very high volume. You see the chart on the screen. Very high volume selling down, right? And the share price continued to go down for another couple of days before it saw a rebound. And now we seem to be settling into a consolidation or sideways zone with a slight upward bias. And of course, readers who have been following me know that I got into Alibaba when it was about Hong Kong $80 per share. And then later on, I sold some at Hong Kong $120 plus per share. And then now I'm buying again, right? So the thing is, I said also that Donald Trump's crazy tariffs has given us an opportunity to buy Alibaba shares again. The boat came back. So it's not necessarily a bad thing, right? The tariffs. No, I mean, it's a bad thing. But I mean, in this context, it's giving us an opportunity to load up on shares of Alibaba. And I did say that, if the share price were to go down to 90 Hong Kong dollars per share, I'll be buying a lot more. But that is if it happens. We don't know whether it's going to happen or not, right? So in the meantime, I'll be nibbling, right? On screen, you see the phrase accumulation mode, because I think that Alibaba at the current price is still good value for money. You're talking about a PE ratio about 11 times PE ratio for a tech company that has shown recovering margins and growing revenue and growing earnings, right? So I believe it still provides good value for money. So if you look at the chart on screen, I think immediate support is about 100 Hong Kong dollars per share, and the resistance, immediate resistance, is about 112 Hong Kong dollars per share. And I think it's going to be stuck in a range for a while, and then we could possibly see a breakout and then fill the gap that we see on the screen and goes back up to 130 something dollars, which is the immediate target. immediate target, 130 plus Hong Kong dollars per share, which is a gap fill. And then eventually, I think there'll be a mean reversion and it goes back up to Hong Kong $160 per share, right? And with all the AI tailwind, like I've said in my recent video, share price could go a lot higher than that. I mean, 160 is the mean reversion, like I said, right? Is not really the intrinsic value, it's just mean reversion. So I see nice upside potential for Alibaba. So there isn't really a specific price that I'll be looking at for accumulation, right? But so right now, I think it's okay to accumulate. It's a zone, right? The zone is between 100 Hong Kong dollars to about 110, 112 Hong Kong dollars is a zone, accumulation zone. And but of course, the specific price is if the share price should drop and retest 90 Hong Kong dollars per share, that's where I'll be buying a lot more, right? And previously I said that the goal is still to have about 3% of my portfolio to be invested in Alibaba. If Mr. Market should go crazy and give me very attractive prices, I might increase that 3% to 5%, right? And if you have been following my blog for a long time, you know that I'm not averse to allocating up to 10% of my portfolio to what I think is a slightly more speculative position. And because I can recover very quickly if things should go wrong due to my passive income stream, my dividends that I get on a yearly basis, which has of course grown over the years. And so if the investment should go, how should I put this? It goes awry, yeah, I can recover quite quickly. So that's the plan. And for people who are thinking of whether to buy Alibaba, whether they should get in now, whether they should add, or if they want to wait for a bit more market pessimism, well, this is just what I think, right? It's not financial advice, right? I just hope that he has given you some food for thought if you're eavesdropping, right? So if AK can talk to himself, so can you. Bye-bye.